Welcome to Intermediate Corporate Finance. This is my second video for Lecture 4 in Intermediate Corporate Finance, week number 2. Last video, we talked about the biases in IPO setting, right, for TOS Bank. The key idea is that every valuation will be biased anyway, right? And depending on your economic incentive and then, which side of the table you are on in, and then the investor psychology as well will affect those valuation numbers. It's an estimation with error. Now, philosophical basis for valuation, let's discuss further, right? Some people say like valuation is often not a helpful tool in determining when to sell hypergrowth stocks. Well, the is valuation totally not helpful? No, okay. But sometimes Henry Blodgett historically he was a very famous analyst in the market during the dot-com bubble. He left this kind of word, okay? And then he was saying like, in January 2000, in a report on Internet Capital Group, the company was trading at $174 then. But, there have always been investors in financial markets who have argued that market prices are determined by the perceptions or misperceptions of buyers and sellers and not by anything as prosaic as cash flows or earnings. But perceptions matter, but they cannot be all that matters, right? All valuations will be biased, but it's an estimation with some errors. Error is not 100%. Okay, error is not 100%. There's a substance in valuation. DCF, the cash flow and discount rate, all these kinds of things matters a lot. Okay, it's a lot of fluctuation in valuation. We cannot trust it. People may complain it, but remember, those are just error bounds that can be moving around. And then true evaluation, right? Largely, it is driven by the fundamentals anyway. Perceptions matter. The error bounds may be affected by the perceptions, but they are not all. Asset prices cannot be justified by merely using the bigger fool theory. Okay, so if you believe that the error is everything, then you may end up saying invest in what you don't know. Oh, don't go there. And then another is a bigger fool theory. As long as you can sell this garbage to a bigger fool at a higher price, then you are okay. No, be careful. PostScript, well, that Internet Capital Group, that stock later got traded around $3, right? Remember these differences, right? More than 50 times difference. Anyway, misperceptions about valuation. The first myth is valuation is an objective, unbiased search for true value. Well, the truth is all valuations are biased. Secondly, the direction and magnitude of the bias in your valuation is directly proportional to who pays you and how much you are paid. I told you before, economic incentive drives your bias. Okay. If you are the CFO of an IPO company, naturally you will be, calling for higher numbers, and then vice versa. Hostile takeover of Lin and by AT&T or telecom company is a famous case Damodaran suggests, right? And then their very interesting thing is that it was a mergers and acquisition deal. And let me start with this clock. Anyway, and then the mergers and acquisition, the AT&T was a big dinosaur kind of big corporation. So it was taking over Lin Company, Telecom. So let me draw a picture for you. Okay. So yes, here's my favorite Pac-Man, AT&T. And here is Ding, ding. Lin, was it Linn? Right? Of course, you know, after it gets cherry or something, it can eat, this monster, right? Anyway, but to take over this target company, how much does this guy have to pay, right? How much is it worth, right? How much is it worth, this guy? Okay, is a question. Value of Lynn. True value, unobservable. But we have the middlemen, right? So Lehman Brothers and Morgan Stanley were advising each, right? Lehman Brothers and Morgan Stanley or vice versa, right? So for the same company, Lin, and then exactly the same due diligence information, they came up with vastly different number. Okay, Lin Technology, on their own eyes, their value should be 155, they said. Whereas AT&T said, "Oh, you guys are worthless, 105. Okay, you don't deserve this one. Okay, just I'll pay you this and just get out. Okay." But this guy was saying, you have to pay me higher than that, right? So investment bankers working for them, right, will come up with different numbers, even though they are working with the same data, same due diligence information, right? So this gap was too big. Then what? A third investment bank gets in, Wasserstein Pirella. Okay. And they came in and said, what? Cut in half and take the average almost. That's 130 or something. But instead of saying 130, they said roughly 127.5. Okay. Well, could be anything, but roughly in the middle. Okay, compromising. Okay, minus $2.5. Why did they do it? Well, just to give an impression that they worked hard, as a joke, right? Maybe. But the thing is, they ended up with this number. Okay, in the middle ground somehow. Okay, so likewise, every valuation is biased and depending on which side of the table you are in. Okay. Um, And if we go back to the slide, yes, yes, like this. Good. I like this board, by the way. Yes. Misconceptions about valuation. Number two, a good valuation provides a precise estimate of value. Um, That's a myth. Okay. Why do we have this kind of myth? Because this is a natural consequence of math education throughout our lives, right? Math and accounting, even though math and accounting are totally different discipline, right? Um, um, we have been trained to deliver absolutely correct answer, especially when we were studying mathematics, right? Of course, the logic and then the resulting numbers have to be accurate, but valuation number itself is just, you know, estimation, estimation. It's more like statistics. We have to think about in terms of that kind of estimation with error kind of concept, okay? And then truth number, the 2.1, there are no precise estimations. Internal consistency is more important. Your logical internal consistency, more important. And then internal consistency, what do you mean by that? Well, if you assume your company will grow very fast, then can it go together with low reinvestment? No, illogical, right? If you're assuming fast growth company, can you afford to pay dividend, right? No. So internally, logically consistent in your evaluation framework, okay? And then the second truth is that the payoff to valuation is greatest when valuation is least precise. For example, least precise means what? Well, payoff to the bankers, iBankers or brokers who broker those mergers and acquisition deals or IB deals, right? Restructuring or whatever, IPOs and M&As. Well, the payoff to you as a banker will be bigger if the company is difficult to value, um, least precise. In contrast, if the company is stable, okay, stable like well-established ExxonMobil kind of companies, well, the cash flow is stable and discount rate, everybody knows about their beta. And is there any growth potential? Maybe, but not as much, right? It's well known already to everybody. So the valuation will be, payoff as a investment banker will be lower if you are doing valuation for such established company, stable company. In contrast, if it is for private company, small company, for IPO setting kind of things, not many people know, and new technology instead of oil kind of stable business, or not a stable but established business, if your business is really volatile, right, then the payoff to you as a banker will be higher by doing that, right? And then mature market versus emerging market. Obviously, emerging market valuation will be more difficult and there will be a lot more error found. Okay. So payoff to you as a valuation specialist will be bigger for emerging market. And low volatility period versus high volatility period. Obviously, a high volatility period like this time in early 2026 is the time when the payoff to valuation expert will be higher, okay, as opposed to low volatility period. What do you mean high volatility period? Go ahead and look at the KOSPI Korean stock market index return today and yesterday and just week-long basis, right? Crazy. Okay, very, very volatile market is happening right now. What is the true value of Samsung Electronics? Okay, even for the stable company, it isn't, yeah, stable company or mature company, the valuation gets very, very difficult. And then the third misconception about the misconception about valuation goes like this. The more quantitative a model, the better the valuation. Not really. Okay. I remember back in 30 years ago when I met some guys, investment banking guys from Credit Suisse, and then the analyst was very proud that she has to input and then try to project 10 years cash flow in DCF Excel spreadsheet. Whereas me, I had to do only 5 years or 3 years. And then, as a debt capital market guy, you don't need that much. I thought that was debt capital market guy's thing. And then equity market stock analyst, they have to do 10 years DCF analysis and things like that. Much more input and much more study. She was very proud. But there's one drawback about that. It's not all, right? The more quantitative and then more input that you have to punch in, the more likely you will be in input fatigue. You have to be parsimonious, right? Don't say our in-house black box model gave me X dollars, so buy and sell and hold. And you have to know the nuts and bolts of the model that you work with, okay? So the more complicated model that if you use, then you are more likely to forget about what has to go inside the model, okay? Make it simple, keep it simple. That's the message here. Keep your evaluation model simple. Also, this applies to your project as well. Keep your model simple, okay? Just PB ratio, multiply it, and then get the valuation number. We already did the exercise. No problem, just do it. And easy to convince the people. Try to do 3 stages or n stages of growth model, very complicated ones. I'd rather not suggest you, okay? Because somewhere in the middle, you are more likely to make mistakes. And then you just don't know where you made a mistake. And it's going to screw up everybody. You don't want that kind of situation. And Don't do projections for longer periods unless you absolutely have to, right? The one's understanding of valuation model is inversely proportional to the number of inputs required for the model. So the one who was very proud and then bragged on me, maybe, um, it's the other way around, okay? May have been. So be careful, right? Be careful. Oh, I have to, input 100 different items into the model. You may be screwing up yourself, right? Um, like this, right? After all, finance guys are living in a very simple world, I told you, right? Which is discount rate and cash flow, okay? And then just Gordon's growth model, very generalizable, and then just use it. Okay. I'm not going to punish you in your project simply because you used golden growth model like this. Okay. One stage growth model, perfectly fine. Okay. Perfectly fine. The intuition is there, reasonably understandable. Just go ahead and do it. Okay. And then, simple model at least saves time and gives you a first cut result. First cut is an important thing, first cut result, so that you have some estimate about where it will be. And then if you have some time, you can make your model more sophisticated and then see if it deviates differently and how sensitively does it change, right? But majorly, the simpler model, the better it is. And remember this, because by the time you get to the final project, you forget all these things and then start to make your model much more complicated and then screw up the eyes of your teammates. Remember, your teammates are not all finance guys. Some of them are marketing guys, some of them are HR guys, strategy guys. You need to be able to convince them using simpler, intuitive model, not complicated model of bragging. I have 10 years input. I am the number guy. No. Okay. Just tell the simple story with the simple model. That's very, very important. Okay. And it tells if you can, make it, if you cannot make the story easy to understand, you're not understanding it. Okay, so keep that in mind. Okay, simpler valuation models do much better than complex ones, right? Very generalizable model works better. Valuation biases. Well, here are some tests I want to check with you. You are valuing your own business for sale to a third party. Well, your own business you're valuing. Would you value your company upward or downward? Okay. Think about your situation going back home, okay? Talking to your mom and dad, how much did you study for Andy Kim's class? Oh my God, it was so difficult and I had to, study so hard. And then, this is, or would you say, I didn't study at all? Okay, I don't know what to do. Did you evaluate yourself as working hard versus working less, right? Intensively working, just like that. And business as well. Oh, my precious business. Okay. Hi. That's the answer. You are a venture capitalist valuing this business for an investment. You are a venture capitalist. Okay. And then you're evaluating a private business. Okay. So you are the buyer. Okay. You are the buy side. Would your would your valuation be biased upward or downward? Okay. You have to buy it low, cheap. So low, buy low, sell high. So you'll be biased low as a venture capitalist when you are buying it, okay? Investing in it. You are valuing your own business for divorce court. Half of your estimated value will go to your spouse, soon to be ex-spouse. So your valuation will be biased, high or low. Okay. I wish many of you will be warm-hearted, but realistically, you know what to do, right? It will be lower. You are an appraiser for the owner. and then valuing a business for tax purposes. So tax purposes, right? The tax will be based on the assets that the owner has, right? So would your valuation be biased upward to pay more tax or lower to save, your money out of tax, right? So you will be biased lower. Yeah. And then number 5, you are an appraiser for the IRS, which is like a government tax uh, authority, valuing the business for tax purposes. So you have to maximize the tax revenue for the government. So when you're valuing certain corporations, then would you value it upward or downward? Right. It's about the negotiation and bargaining. So you have to value it upward, and then things will go on. So high will be the answer. Number 6, you are a sell-side equity research analyst valuing a company with the intent of putting a buy recommendation. It's 답정너있ly you are already determined. The beauty is in the eyes of the beholder. You are like, oh, this is a great company. Buy it. So you will be biased high, right? To justify your argument, right? Every valuation will be biased, right? Number 7, you are an M&A analyst working for the investment banker for the acquirer, valuing the target company. We did it before, right? Valuing the target company, well, high, low. Low, right? So you will be able to buy it cheaply. And then you are 11, you are buy-side analyst valuing a company for your portfolio manager who already happens to own 1 million shares of its stock. Okay. Your boss has NVIDIA. Okay, already has NVIDIA. And you are valuing NVIDIA right now one more time. Would you be biased upward or downward? Okay. Um, your career is at risk. Okay. If you say, why did you buy that stock? It has to be cheaper than what you paid for. Then that would make your boss feel stupid. And then chances are he will say, get out. So you'll be biased upward, high. Okay. And then 12, you are buy-side analyst valuing a company for your portfolio manager who already happens to have shorted 1 million shares of its stock. Okay. Um, would you be biased upward or downward? Downward. Yeah, boss, you sure sold the stock. Great job, man. Um, that's your career concern, right? Drives you to be biased in such a way, right? So in finance, there's nobody you can trust, actually, right? You have to be able to think independently, right? Because everybody has their own biases when they come up with valuation, even your subordinates or neighbors and friends, okay? Will tell a story that always compliments you, right? Um, Not good, not good. So be aware. That's the key message here. And then I'll move down to the next set of slide. Thanks for watching. Just a minute. All right. So I'm getting back to lecture note 3, right? Now we understand, all valuations will be biased, either upward or downward, depending on your economic incentive. And then the valuation is estimation with some errors anyway. Okay. But error is not everything. Okay. It is minor thing rather. What is more important is the economic fundamentals that drive your valuations, cash flow and risk, right? Those two are important. Um, then in valuation, what are those families of valuation that we will meet, okay, throughout this semester? Damodaran's book, he proposes 3 different families of valuation, okay? One is absolute valuation, 2 is relative valuation, 3 is contingent claim valuation. So absolute valuation is what we call DCF, discounted cash flow method. For example, free cash flow to firm, or free cash flow to equity, or residual income model, or economic value added, and all these kind of things are DCF, absolute valuation model. There, the value is nothing but the summation of all the expected future cash flow discounted at relevant cost of capital over the infinite horizon starting from tomorrow or in the future. And then it can be simplified into a golden growth model, like the last term for there in the equations. Now, the second family of valuation is relative valuation, which is what we've experienced with Postbank IPO exercises, PB ratio, PE ratio, EV to EBITDA ratio. Most of the things are market price divided by something fundamentals. The fundamental numbers come from your accounting book, or sometimes they use the number of clicks. So price per clicks or price per eyeballs, and then the price per price per site visitors and kind of things, right? Um, that's relative valuation. The third category is contingent claim valuation. This is a totally different family because it uses Black-Scholes formula, and then it uses option pricing framework to measure the value of assets that share option characteristics. For example, oil, how do you say, the right to extract oil in a certain area, okay, over a certain period. Right, okay, how much do we have to pay for the right, okay? That's option idea. Now, basis for all valuation approaches in an efficient market, the market price is the best estimate of the value. The purpose of any valuation is then justification of this value. The value of the use of valuation model in investment decisions, in decisions on which assets are undervalued and which are overvalued. They are based upon a perception of that market are inefficient and make mistakes in assuming value on assumption that about how and when these inefficiencies will be corrected. Now, so to a certain degree, okay, we do valuations and to make money because we are, in the short run, to a certain degree, we don't believe in market efficiency. Okay, that's the key message here. If the price is always equal to true value, if the market is efficient, 100%, then there is no room for us to make money. Okay, there is no chance for us to make excess return. Okay, it's going to be useless to do valuation on ourselves, right? So we do the valuation. We try to be, value investors because we don't believe in market efficiency. So as it turns out, if you talk to the guys in the fund and then the analysts, right, they are not believers of market efficiency. If you are a believer of market efficiency, you will invest in index fund only, passive investment. But you do valuation primarily because you are an active investor, not a passive investor, right? And then DCF framework looks like this over here. I don't know why this camera got expanded and then magnified like this, but the picture, okay, I should show you somehow. Yeah, push this one that way. Okay, all right, there we are. Okay, somehow, I think we're going to, yeah, right. Right. DCF valuation on a time horizon is shown over here. We are standing at time point 0, and then future cash flow is what matters. Okay. And then next year, 2 years later, 3 years later, tau years later, and then infinite horizon. Those cash flows has to be discounted as a present value using the required rate of return R. And then in a compounded fashion like this, aggregate everything, right? The cash flow, we assume it to be growing somehow. Anyway, discounted cash flow valuation, what is it? Well, in discounted cash flow valuation, the value of an asset is the present value of the expected future cash flows generated by the asset. Philosophical basis is that every asset has an intrinsic value that can be estimated based upon its characteristics in terms of cash flows and growth rate and risk, right? But the growth rate itself is about the cash flow. So everything boils down to two things, which is about risk and cash flow, right? Information required should be, of course, cash flows and discount rate. And then perhaps the life of the asset. We are assuming infinite life of any companies, 계속기업, 가정, in accounting and just like that. So market inefficiency is also, we assumed here. Markets are assumed to make mistakes in pricing assets across time, and they are assumed to correct themselves over time as new information comes out about assets. So at some point, you will have to address these questions, right? If you argue that you have to buy NVIDIA, or if you have to buy Palantir, then the listeners or the fund managers will always argue. If your argument is correct, why isn't it priced right away? Okay, why is there inefficiency? What's the friction in the market so much so that there's a deviation? When would it be, how do you say, what is the catalyst that enables your valuation to be correct, and then eventually you will make money? And you will have to address this kind of question later on. When does that happen? Okay, convergence to the fair value, right? DCF valuation framework. I mean, pictorially, it looks like this, right? So always a time horizon is there going forever. You're standing over here, okay? And then we will get to this picture later on, but the whole framework is about what? Discount rate and the downside over here. Discount rate, how to estimate those returns based on your betas and market risk premium using capital asset pricing model, or it can be other APT model or Pharma French 3-4 factor, 4-factor model, whatever it may be. The important thing is, this is about the R, discount rate. Okay, I told you. Okay, don't lose threat. 정신줄 놓지 마세요. Okay, the valuation, you need only two information. One is about discount rate R. The other is about the cash flow in the future. So Damodaran proposed this, nice diagram that really splits into two parts: discount rate and cash flow. Okay, cash flow over infinite horizon. Okay, and how do you estimate those things using some reasonable, economically logical framework? We will study those things in the future. So get ready for that. And then after all, we are all getting into that present value. And how much should it be, right? So that's DCF valuation. Advantages of DCF valuation. Well, since DCF valuation, is done right, is based upon assets fundamentals like cash flow and risk, right? It should be less exposed to market moods and perceptions. So this is something good about DCF valuation. Warren Buffett used this thing and then tried to be less affected by the psychology, and then calmly, peace of mind, and then value the companies and determine whether it is overvalued or undervalued, right? And then if good investors buy businesses rather than stocks, then the Warren Buffett's adage, discounted cash flow valuation is the right way to think about what you are getting when you buy an asset. Okay, you buy company, right? You're buying the business, right? So this is a solid way of understanding the industry and business. My students in the corner, the corner is a student club of valuation, and especially they do DCF valuation very intensively. This is the advantage and then the positive side of doing DCF valuation. After one semester of training or two, they become experts in a certain industry and they are very thorough in getting their cash flow and risk correct in a certain industry they focus on. And then DCF valuation forces you to think about the underlying characteristics of the firm and understand its businesses. If nothing else, it brings you face to face with the assumption you are making when you pay a given price for an asset. So really, it enables you to study hard about that industry, okay? Which is really good for your life anyway. But it's not, good things only. There's disadvantages of DCF valuation. What is that? Well, at first glance, what do you think? Input fatigue. Oh my God, so many inputs that you have to think about. And then when you talk to fund managers, can you discuss all these kind of elements in 15 seconds? No. Okay. Difficult to communicate, complicated model. So it takes time. Since it is an attempt to estimate intrinsic value, it requires far more inputs and information than other valuation approaches. These inputs and information are not only noisy and difficult to estimate, but can be manipulated by the savvy analyst to provide the conclusion he or she wants. Um, can be manipulated and then in their own ways. And then the beauty is in the eyes of the beholder, I told you again and again. So each and every element, okay, there you can tweak a little bit, okay? So you have to be careful about those things. And then in an intrinsic valuation model, there is no guarantee that anything will emerge as under or overvalued. Thus, it is possible in a DCF valuation to find every stock in the market to be overvalued. This can be a problem for equity research analysts whose job is to follow sectors and make recommendation on the most under or overvalued stocks in that sector. So for using DCF valuation, at one time in 2000, Warren Buffett courageously said, I cashed out everything because every stock in the market is overvalued. Sold out, okay, cashed out. Bye-bye. And afterward, the market tanked. And then he, started to invest it back again. Now, he was courageous and was able to do that because he is the CEO of a fund, right? Or insurance company called Berkshire Hathaway, right? Private equity, you can do that too, right? But for for mutual fund and hedge fund and the usual fund managing businesses, well, you cannot sell all the stock. You cannot cash out everything because by definition, you need to hold certain portion of your money in equities, in stock market, okay? There is a fixed income fund or equity fund. Well, they specify, like, for example, our fund will be investing 70% in the equity always and 30% in the fixed income bond market, then you cannot cash out everything, okay? In those settings, you just need to hold on to relatively undervalued stocks instead of, cashing out everything. And then equity portfolio managers who have to be fully invested in equities, right? You cannot use DCF as much, okay? So that is a shortcoming of this kind of model. When do DCF valuation works best? This approach is designed for use for assets, firms that derive their value from their capacity to generate cash flows in the future. It does make your job easier if the company has a history that can be used in estimating future cash flows. So DCF, a lot of input, a lot of expert information you needed. So if there is no expert information in certain industry, you are in trouble. Okay. And if you cannot punch in those inputs, you are in trouble. So newborn industry, for example, AI recently burgeoning. Well, compared to food and beverage, less information is available. And historical data as well. Food and beverage has been together with us throughout human lives, right? And Coca-Cola and McDonald's, people eat and drink, right? So you have the historical data to gauge how the company will do in the future. But for AI, right? Palantir kind of companies, right? There was no predecessors, right? No data that we can use and infer how the Palantir will perform in the future. Okay. So DCF valuation does not work well for Palantir kind of new tech companies, high tech, new technology, AI kind of companies. It works best for legacy companies, right? And it works best for investors who either have a long time horizon, allowing the market time to correct its valuation mistakes and for prices to revert to true value. So the second point is, if you are Warren Buffett kind of long horizon investor, long-term investors, DCF works for you. Because once Berkshire Hathaway takes a position in your company, for example, Daegu Technology was the one that received Warren Buffett's investment, and then Warren Buffett held that position for about 8 years or something. Once they stack up their position, they just keep it long term. Okay, and then this DCF valuation works best if you are capable of providing the catalyst needed to move the price to value, as would be the case if you were an activist investor or a potential acquirer of the whole firm. So if you are private equity managers, like Align Capital, right? So much so that you can change the board member of the target company that you are interested in, or if you can kick out the CEO and replace them with a new one that you know working with very well, or influence the CEO to go into a strategic direction that you propose, then okay, you have the catalyst, right? Then DCF valuation framework is good for you. Otherwise, DCF valuation is not that helpful, okay, other than understanding the industry, right? So that's something to tell you. For relative valuation, I'm going to talk about it in the class face-to-face on Monday. See you. Bye-bye.